Let me bring on board Pankaj Pandey, Head of Research with ICICIdirect.com. Pankaj, I guess it's easy to understand the market setup. Financials are correcting. FMCG stocks, irrespective of rich valuations, are still appreciating.
Morning, Nikunj. Yes, you're right that the markets are again getting more aligned towards defensives. I think what is positive for defensive is that the top line and bottom line growth is still in double digits compared to the rest of the markets where there is a degrowth in top line or a very moderate kind of a growth. And I think of late banking sector is also getting impacted, largely PSU banks, because I think there's no respite on the asset quality front. Plus, what we are seeing also is that the provisioning requirement is likely to go up over the next 3 or 4 quarters. In addition to that, from FY15 onwards, they'll not have something like a restructured asset bucket. So in that sense, earnings quality or earnings growth is likely to be quite muted for PSU banks. I think the private sector banks are likely to hold up well. I think in this particular quarter, we are expecting them to do an NII growth of about 22% and bottom line of about 24%. Going forward, also, we still expect that the defensives will continue to hold because the other segment of the market, which is the capital intensive, they are still not showing any kind of improvement. So we are in a scenario where the defensives are getting re-rated. Some of the FMCG stocks like Nestle and HUL are trading over 40 times FY15, and that's still counting in terms of whether further re-rating would happen. In addition to that, if you look at, I think the beaten down sectors are getting even more, they are getting even more punished despite even lesser decline in earnings. So in that sense, the skewness in the market is increasing, and it is very difficult to find investment opportunities, or it will be very difficult to jump from one side to other side. I think that is the situation is getting from bad to worse.
Pankaj, what have you made of the significant outperformance that we saw in the FMCG names yesterday, and in particular in Unilever?
I think if you look at, like I said, the entire FMCG index is up about 25%, and 2 of the leading players, which is HUL and Nestle, are sort of trading upwards of 40 times on a FY15 basis. That's quite expensive. Although from a result perspective, if you look at, or from an overall growth perspective, if you look at this, no significant change in the earnings DNA of these companies. So in that sense, the re-rating continues, and going forward, I think for the rest of the year, it is very, in case if the other segment of the market, which is your capital intensive, does not see any sign of revival, I think it is largely the parking of or the reshuffling of the portfolio which is happening, and it is really not got to do with the kind of earnings growth which these companies would display. So in that sense, it is largely the fear psychosis which is working as of now compared to the earnings growth of the sector.
Pankaj, for a minute, if we assume that the strength in FMCG sector is here to stay, do you think now it's a matter of time mid-cap FMCG stocks will also pick up some steam? Because still there is a big P difference between a Nestle and a Emami, or a HUL and a Godrej Consumer.
You're right, Nikunj. There are certain stocks which one can look at. Say, for example, what we like is something like Kansai Nerolac. I think it is trading at about 13-14 times, so relatively significantly cheaper compared to the other players. But then again, the company is suffering from the fact that they have got 50% kind of an exposure to industrial paint segment, so which is where the demand is really not coming up. But our sense is that whenever the demand gets revived, so one can look at stocks like these where the valuations are really not that expensive, and there is a good scope in case if the economy turns around, the stocks like these are doing well. But I think, again, it remains to be seen that how a situation pans out, because the entire mid-cap index is still not doing quite well. So they are still down about 14-15% compared to markets being flat.
Pankaj, we saw what Infidad did in terms of a positive surprise when it comes to their guidance. What's the expectation then from TCS today?
We expect TCS to be a consistent performer, so we are expecting US dollar revenue growth of about 4%. So in that sense, we would always prefer TCS because from a defensive pack, you don't want volatility in a situation which we are into. So the overall environment itself is volatile. So you would want from defensive some kind of a stability. So which is why I think TCS has been doing quite a commendable job. And we are expecting another decent set of quarter for the company. And since for them H1 is likely to be better, so we expect a good set of numbers. Probably we'll have to revise our target upwards, but I think even at about 18 times forward multiples, the stock is still attractive compared to other defensives like FMCG. So IT and pharma are clearly better bets compared to FMCG.
In last 3 days, I've read at least 6-7 reports, and the common theme in all the research reports is avoid domestic-oriented businesses, focus on pharma, focus on IT because they are immune to Indian economy. Are you slightly worried about this consensus call because consensus rarely gets it right?
You're right, Nikunj. I think what is driving factor as of now is that the kind of rupee depreciation which we have seen, and a lot of companies, domestic-oriented companies which have got any kind of forex exposure are getting impacted. But I think the rupee depreciation again would put a question mark in a number of companies like, for example, auto, or for that matter bank. Auto was expected to be a big beneficiary, but then again I think this entire rate cut cycle has come to a grinding halt. So in that sense, the fortunes of a lot of domestic manufacturers are at stake. So in that sense, as of now, there's a good visibility in terms of IT and the pharma stocks because like I said, if you look at from an earnings growth perspective, you would still see these stocks are trading somewhere about 18 to 20 kind of a forward multiples if and a number of stocks, in fact tier ones, are trading less than that. So if you look at from that perspective, I think within defensive these are still fine where you don't see too much of a divergence between the earnings growth and the market price performance. For example, IT and pharma are up about 20% as index basis. FMCG is up about 25%. And earnings growth, if you look at, for example, pharma is likely to deliver about 19% kind of a top line and 17% kind of a bottom line growth. So still not really significant divergence between the earnings growth rate and the kind of multiples what they are trading. So I think it is still quite fine. I think I would still prefer these two kinds of a stock, but yes, probably the consensus is also looking at these factors. I think domestically we are not seeing much of a revival because, I mean, if you look at a beaten down sector like construction, I think what they had got orders was about 7,000 odd crores for our coverage universe. I think in the last quarter they've got about 2,800. So there's hardly any sign of sort of a visible improvement. So unless we don't see that, I think probably IT and pharma could also witness or continue to witness re-rating like the defensives or like the FMCG where the multiples have significantly expanded because the growth in FMCG is still about 15 to 20% range, so not beyond that. And the sector index itself has delivered 25% kind of a return. So in that sense, I think the IT and pharma could still get re-rated if this kind of a scenario continues for some more period of time. So in that sense, I would still hold a view along with the consensus.
Pankaj, what's the call on HDFC Bank now? While it's delivered yet another steady PAT performance of 30%, the gross NPAs in absolute terms have risen, and it's also a case of higher provisioning, and the CASA as well has dropped significantly. What's the call on the stock price now?
See, if you look at from a multiple perspective, the stock is quite expensive at about 3.7 times forward basis. I think if you look at from the overall private sector banking space, we still expect the entire pack to hold up well compared to the PSU pack because in the private banking space we expect an NI growth of about 22 odd % and bottom line growth would be about 20 odd %. So in that sense, it is still fine. I think HDFC Bank, if you look at has been delivering on the expected lines and has been commanding those expensive multiples. So there is not much of a positive surprise. I think some bit of a higher provisioning is slightly negative. So in that sense, we don't expect this stock to do much from current levels, though it will continue to remain expensive, which is why we have a hold rating on this stock with a target price of 650.
Pankaj, do you think it is time to avoid buying into private banks? The world's bullish on private banks. Private banks are extremely underowned. Everyone is of the view that private banks could do no wrong. But at a time when economy is unlikely to recover, GDP estimates have been slashed down. Do you think one is better off giving even private banks a skip?
Well, you're right, Nikunj, that the overall fear in private sector banks would be that somewhere down the line the slowdown will also grip them, and probably what PSUs are struggling, not of that scale, but there will be some bit of a pain on the asset quality front from PSU for private sector banks. That is quite possible. So in that sense, again, we are left with only 2 or 3 sectors. In fact, media is another sector which is likely to do well with a 15% kind of a top line and bottom line growth. So in that sense, one can look at private sector banks, but then again, I think one cannot be sure that these are very attractive levels. So there's a good chance that since the economy is not really showing any visible signs of improvement, so you could still expect probably that these stocks one can get at lower levels. So that is definitely a possibility, because I think a lot of beaten down stocks, if you look at on the infrastructure side, I think it is very difficult to figure out where their bottom would be, because they are still declining. So in that sense, probably not expecting that the same fate would happen to PSU or private sector banks. But then again, I think market is quite ruthless in terms of that. So which is why probably if things are really not improving, one should not be really chasing them heavily at current prices.
Pankaj, at a time when markets clearly are not rotating and money is moving only in 3 sectors, FMCG, pharma and IT, where are you picking your spots in pharma? Because pharma space again is very divided. One side you've got laggards like Aurobindo Pharma, other side you've got winners like Sun Pharma.
Well, Nikunj, if you look at from a 1-year perspective, it is very difficult to sort of find stocks with a good risk-reward perspective. But having said that, I think in pharma, if you look at, there are certain stocks which are still sort of doing a very stable sort of numbers, one being Lupin. We also like something like Ipca, Cadila Healthcare, so even Glenmark Pharma. So, but then again, from a valuation perspective, if you look at both Sun Pharma and Lupin are trading upwards of 20 kind of a multiple, whereas the other pack is below 20. So I think given that the fact that there are a lot of re-rating which has happened for defensives like FMCG, probably pharma might sort of again see some more re-rating happening, though they are quite expensive. But then again, from a growth perspective, if you look at, I think like Lupin is expected to deliver about 20% kind of a growth. Even Ipca is expected to deliver about 19% kind of a top line growth. So in that sense, they are really not expensive compared to the growth what they are delivering. So I think the market is actually respecting or looking at a scenario where even if there is a good growth, I think probably a market is giving a higher multiple, because somewhere down the line it is still better than a number of sectors or stocks where the decline is still there in terms of earnings, like the case, for example, NMDC. The stock is really not doing well, though there are no major concerns on the balance sheet front, but then again, I think there are concerns on the growth front.
Pankaj, what is it that you're expecting to hear in the IGL PNGRB case? Because given the kind of long build-up that we've seen in IGL, the stock price is telling you something.
We'll have to revisit, because our current target price is 265. I think in the entire oil and gas space, we've been positive more on the upstream companies, which is your ONGC and Oil India in particular, because I think both these stocks are trading at about 8 to 9 times forward basis, and plus I think any kind of a gas repricing if it happens, though it is again contingent upon the next government. But then again, I think if that happens, you will see an EPS revision of more than 20%. So in that sense, we would prefer these stocks, I think, compared to the gas transmission or players or the downstream companies. So in that sense, I think upstream companies do make better sense compared to the gas utilities or the downstream players.